Welcome to Power Charting. I am your host, Bruce Frazier. With me today is our very special guest, Roman Bogomazov, and we are going to do part 2 of our case study series on Nvidia. Roman, thank you for being here.
Always happy to hear, Bruce, to be here.
It's wonderful. Now, we are going to really dig into the nuances of the Wyckoff method in chart reading, something that our guest, Roman, my teaching partner for many, many years, is so good at. And you're just going to see that demonstrated here. So if you want to be a world-class chart analyst, this is the kind of work that Roman does, and he's going to tell us more about the class that he teaches. Roman, you have a new semester coming up in the fall. Tell us about it.
Yes, we're going to start on August 28th. And Bruce, by the way, thank you so much for all of this kind words from you. Again, comes as a high praise because I know how talented you are in the Wyckoff method. So thank you. And yeah, we're going to start on August 28th. This is an open door session. So come in, a very relaxed atmosphere with a lot of knowledge, even in the first session. And I'll show you what the whole course is about. We'll talk about the price structural analysis, which is the most integral part of the methodology itself, just to understand how the price unfolds and the reasons of why it unfolds the way that it does. And then obviously, behind all of this analysis, there will always be the understanding of the trade management, where we understand how we actually trade what we see on the chart. And sometimes people come to us with the mistaken kind of like idea that we're going to improve their underlying P&L results. We don't do that. What we do, and we have only one guarantee as a company. We guarantee you that after you have taken our classes and properly have done all of the homeworks that we suggest with our feedback to you and with your potential changes that you take throughout the course of our different series, you're gonna come out being a way better chartist. You will be able to read the chart way better, and that's what I personally see from students that go through our educational curriculum properly, and that's what I would like to suggest to you to do. So we're welcoming you to the first open session, but I also want to say that Bruce and I, we've collaborated on many things. And one of the most successful collaborations that we've had was on the Wyckoff point and figure charting. And the reason why it was is because obviously we come from the same camp, from Hank Pruden camp, who emphasized PNF a lot. And then Bruce has just become, just #1 in the world, on this particular subject. And the beauty of this subject is that it could be studied as a standalone tool in your trading. I mean, you don't have to have anything else, really. You could just use that information, and that would be sufficient. So the topics that we cover is in line with this idea. So for instance, how do we do the horizontal counts? And Bruce can show you how he does this exactly. We talk about, the stepping stone counts, the how do we tape read off the PNF chart? How do we use it for the swing counts, intraday counts? How do we do the percentage scaling, which is a very advanced technique, and so on and so forth. So there are a lot of quite interesting topics for the analysis and for trade execution itself. And currently we have back to school sale. So we are at $698. Make sure that in the next 2 weeks until August 31st, you have an opportunity, to buy this course at the discount. And Bruce, that's it for all of the announcements. Would you like to add something, and maybe specifically for the PNF course?
I specifically want to say something about the WTC course, session 1, 15 weeks. this really does follow the trajectory of the class that we taught at Golden Gate University. Hank and I started the class, taught it together for 27 years. Roman became a co-contributor as a teacher to those classes. And so this course, as it stands, is actually, I think, even more rigorous than what we did in the classroom. So here's an opportunity from your home, from your place of work, to be able to study. And this is work. This is like a graduate semester course in the Wyckoff method, and it's rigorous. And my experience with this is it's every bit as demanding as the course we taught in the classroom. And so you're going to work here. And as a result of that, you're going to become ever better at your craft. So I just want to say that because I've been doing this for so many years with our dear friend, our mentor, Hank Pruden. And I just think that you're going to have a great experience with WTC Part 1, which is going to have you wanting to do the Part 2 and onward from there. And Roman, I just wanted to say that.
Well, thank you. Thank you, Bruce. All right. Well, let's go to our case study for today. Bruce, we're continuing with the Nvidia, and in the last video, we have discussed this distribution and then this decline right here. So today is a very interesting continuation of the whole Wyckoff story that unfolds on this chart. And when you start looking at the next structure that we see, which is this trading range right here, I want to ask you this question. As an advanced chartist, what do you look at first in the trading range? Like, what is your mental routine of looking at the chart, and what is the first step? What is the second step?
Well, the first step is to look for the evidence of stopping action of a decline. And this is very important because this is the beginning of the accumulation dance. This is where accumulation starts to unfold and can take months to years to happen. But it's very important to identify the selling climax and the automatic rally. And if you have a good selling climax and automatic rally, it's like a match set. They go together. And once you have that, now you're able to draw support and resistance, and without knowing anything else. This is maybe the only thing you have on the chart that you can look at, but that support and resistance is going to inform the outer bounds of trading in this instrument for the foreseeable future. And from that, we're going to be able to derive tactics, considerations about future direction, whether it's accumulation for a rally, a rise, or whether it's redistribution for another decline. And it's going to take time for that to happen. But that is the dance that we do with the Wyckoff method, is to effectively draw that information from the price and volume characteristics of the chart.
Beautiful. I love everything that you said, Bruce. I mean, this is so crucial. And one of the easiest places to identify, phase A is going to be that stop in action. You're going to see that selling climax with the specific characteristics of gaps, increased downward spread, increased volume signature specifically. You see the general capitulation by both institutions and public, and
what a magnificent example.
It's beautiful. It's probably one of the classic looks that we usually would have. And then
I was only going to say that this dropped from 48 with a gap down to around 32 and a half, and look at the speed with which that happened. It's a magnificent decline with tremendous volatility all the way to the lows. And Roman, to finish your thought.
All right. Well, let's kind of like go through this further. Stop in action, selling climax. Then we have the rally that's going to have different character than the previous rallies. So look at this rally right here. Look at this rally right here. What do we see? This is an extremely weak rally. This has some demand in it, but still it doesn't extend above the breakdown point that much. And even though it's big, this one is larger, right? So look at this. And then definitely presence of the demand, consistency of the demand. And this is the best rally out of 3. So that's our change of behavior. A change of behavior rally equates to the automatic rally. And we know that phase A, with the intent to stop, is going to have also a secondary test. A secondary test is going to be a local test of the stop in action. We want to check on availability of selling supply, how high it is relative to the anchor point of the selling climax itself. And here we're seeing, so this is, minus 50%. This is a pretty significant decline in selling. But we also see that secondary test did not stop at the exact point of the selling climax low. It actually went down. The extension matters. It shows you the weakness of, the structure based on the selling that has happened. So a lot of momentum into the climax, and that is suggestive that we might overshoot and go into the lower low. So we know that it's going to be somewhat of a struggle, to rally. That's number one. And secondly, probably the duration of the range is going to increase because still selling kind of, has its effect. And right away, we see a place like this after phase A and phase B, where there is a supply spike and very aggressive move to the downside. So still, there is that bearish sentiment that, pushes us down, but that also creates opportunities for institutions to start accumulating the stock on the wholesale basis. The first time when they did so was in the area of the selling climax itself. Selling climax presents an opportunity for the institutions to see 2 things. They could see a long-term value after a very substantial decline, and they could see short-term liquidity, which rises out of the necessity to sell by weak hands. So weak hands are selling. At the same time, strong hands, institutional hands, specifically value investors, are buying. And look what happens. I mean, like the whole idea of increase of the volume signature is, could be easily deciphered. Because the buying is going up, demand is going up. Because the selling is going up, supply is going up. With these 2 forces increasing, overall volume signature is going to go up and become climactic. And that's how the climactic volume is being formed. And then from here, Bruce, I want to ask you this question. When we talk about who is the buyer at these lower levels, we speak of the composite man, composite operator, institutions, institutional money. How do they do this? I mean, and how specifically, I guess the question is even more, how could we see the signs of their accumulation in the lower part of the trading range from the chart, from the price and the volume?
Composite operator is a very specific, high-level, highly capable subsegment of institutional managers, and they tend to be the best of the best. Their objective in accumulating a stock such as Nvidia is, once they make up their mind that they want to own this, they want to, if they can, average cost their ownership of this stock, their purchases, in the bottom half of this trading range. That is their ultimate goal. Now, you can see that this is very, very hard for them to do because Nvidia does not spend much time in the bottom half of this trading range, which is a very bullish signal from this stock. You see a small swing trading structure there from March of 2019 back to November of 2018, the climax low. That's like a little swing trading structure, and it's able to produce a rally that goes up and out. But the thing that the CO will do is they will conduct their purchasing campaign in the bottom half of the range, and they will buy during bouts of weakness. So as prices are falling, you can see volume is high, and that is the weak holders giving up stock, giving up their ownership, and the institutions absorbing that. And they're going to absorb it in such a way that they will not create demand that's going to drive the stock price up on themselves. They will never work against their best interests, which is to buy at a value bargain basement prices. And so you can see over here, June is the last time, May, June is the last time that this stock is able to decline back to the area of support, making a higher low. The low in December is followed by a higher low in January and a higher low in June. And so the volume, you can see that there's persistently high volume on those declines, but less so each time. And so that is evidence of absorption of shares and that there's less stock available to buy. And so now for a CO to complete their ownership, they're going to have to buy on a scale up off those June lows. And you see there that the next decline in August only can go to the midpoint of the accumulation structure, which is exceptionally bullish. And I would even make the point that you can see the selling climax low in the support line there. That is every time it goes to that, it has buoyancy and comes back up into the structure. That's a hugely important sign to identify for a Wyckoffian on these charts, is to see that there's the inability to have followed through of weakening prices below that support level, which shows that is the outer bounds of the value zone for these composite operators. Roman?
Well, that was beautiful. Yeah. Okay. Let's continue. Gosh, this is so much fun just to go through this. We create what we call a Wyckoff story. So a Wyckoff story just tells you from the price and the volume, the story of effort versus result, and then you could create the story about what different market participants actually do during those periods. So we stated that at the stop in action, the CO is buying, the weak hands are selling. This buying produces first, stop in action itself. Second, reversal and short covering. It forces people to short cover. And that produces that change of behavior. So we see the buying behind this. As the buyers release, they're done with buying, those institutional buyers, they let it just kind of be and slide. So selling might increase, but will be definitely drastically less. That brings us to the value zone, and we're still seeing some buying by the composite men. And then less buying than on the first two attempts, which leads to the rally and shows that the price structure is stronger than we thought, maybe, during the downtrend. We're seeing that all of this buying in this area produces some strength and it covers the gap, which is very important. But no one wants to buy above the gap, so that brings some period of inactivity. We see this in the volume signature. Some profit taking starts to take place, and that leads to some closure of positions, though profitable, but not substantially profitable. And with that, that leads us to the phase C, the final phase, where selling is on the profit taking, but not significant. And it only brings out the CO back, and CO adds to the position, and that finalizes the period of absorption. A series of lesser buying could produce a sign of strength or a minor sign of strength into the area of the resistance. Ability of the price to hold here is essential, because every time there is an attempt to go down, there is a recovery, and behind the recovery is increasing demand, which is also important. And then we see how finalized last reaction looks like in terms of non-availability of the supply. Selling is exhausted not just in the lower part of the trading range, but actually at the level of the resistance in the area of the dangerous gap down that we have had. This concludes the whole accumulation, and now we are ready to go up. And Bruce, if we would look at this part of the structure, this is the uptrend. How would you describe it? What do you see here? How would you read the chart there?
Well, let me ask you to do one thing first. Will you draw the hinge from May to September, October? Will you draw that? Yeah, that hinge right there. And the accumulation structure is a period of absorption. This is something we look for. Not all trading ranges are accumulation. And so very important concept is for us to understand that when we see the evidence of accumulation, and a hinge is a great way to visually see that or demonstrate it. And note that in August, that pullback, even with that little gap, goes down only into the midpoint of our trading range structure, our accumulation structure, and stops there, turns back up again. And then each one of the subsequent reactions, late August, late September, are very shallow, dull, diminished volume, as Roman pointed out. That further confirms that this hinge says that we are in the very late stages of accumulation, that the stock has been wrapped up by strong hands, and it is done going down into the lower support levels. And then you get this beautiful breakout. And that breakout right there is one after a backup that you want to be accumulating, and accumulating the lower lows that we have back there in May, June, August, and so on. We want to be in alignment with the activities of the composite operator. That subsequent rally that we have, and we are, Roman, going to go over in time because there's so much more to talk about. So give us a few extra minutes at the end of our normal 25-minute segment. But look at what happens is that out we come out of that hinge, that accumulation, into a markup phase. And notice how the markup phase becomes ever more, call it strident, as it's going up. Look at that December rally that occurs. I mean, it starts to accelerate. And then in February, it culminates with a substantial climactic run, a surge that could be considered to be an inverted V-type top, and very dramatic into February, and then results in a pullback, which is followed by a secondary test to a lower high in early March. And that sets up the conditions for a more important decline. But Roman, what I would be looking for is I'd be going back and looking at the accumulation structure and identifying where key resistance and support is, and that it goes right there. And so we don't want to take our eye off the ball here, because we are seeing, and I want to make another point, that note that at the point of the last backup in late September of 2019, look at the relative strength. This is a very important point to make about relative strength, is that when you're in good accumulation, usually around the time of completing accumulation is the time at which the relative strength is firmly in a leadership posture. Note the accumulation type structure that's occurring in relative strength, in addition to what's going on in price. There we have a backup in late September in relative strength to the moving average, which is flattened out and turning up. And that is accompanied by a stock price that's ready to go into a markup. Institutions, composite operators have been the early buyers. They're the innovative buyers in the accumulation. But then the early institutions, after the COs, will step in and see that the relative strength is starting to turn up. That is an absolute condition of a good institution, as they want price appreciation and relative outperformance. That relative strength chart is demonstrating the relative outperformance in addition to prices getting ready to go into a more important markup. That's the main point I wanted to make, Roman.
All right. Okay, well, let's finish this. We have a little bit left here. So the uptrend that starts at the lows of the phase C. So this is how in WTC1 we identify the beginning of the actual trend low. Not necessarily the low that is the lowest low, right? For instance, in phase B, we could have this. Other scenarios would include even the selling climax being as the lowest low. But the trend starts in phase C, at phase C low. We see the first momentum to buy, then we see the vertical absorption characteristics of the uptrend with a lot of reactions on the profit taken as the price reaches the new highs. And then the last segment of this is going to be a speculation. And here we see this speculation both by institutional hands and by general public. And with that, that produces an overbought climactic after the climactic run. This is our stop in action, our actual buy-in climax. Change of behavior as an extension of the reaction, the largest reaction so far since the beginning of the uptrend, suggestive that we're changing environment from uptrending to non-trending environment, or in some cases like this one, into the downtrend immediately. So like a vertical V-reverse top, which we would call a hypodermic top. But obviously driven by COVID, behind this decline, a black swan event, something that you probably can't, predict the impact right in that moment. I just remember trading through that, and it was really, really difficult, especially like the first week of this whole thing to even understand what's coming. But as
Roman, how would you interpret that COVID reaction that occurred in terms of the overall health of Nvidia as a stock? How would you interpret this? Because we're looking at it in a vacuum. We're not looking at other stocks.
Yeah, of course.
But what really stands out to you here?
Yeah, we understand the context of during which time this reaction has happened. The context could be two-folded here. First of all, the reaction itself in Wyckoff terms, where does it fall? It fall after the major sign of strength, after overcoming the all-time high, which shows extension above that high as a strength characteristic, into the support area, which acted before as the resistance. So structurally, it's a sound place to come and stop and to find some buying. But the context of the COVID creates a question if this is the stock for us to select for further campaigning. And it definitely is because of what the relative strength shows. And Bruce has described it, so I'm not going to go into this. But that strength and the Wyckoff structural spot of a backup action creates an opportunity for us to go in and to be actually aggressive buying the stock on the way up. Bruce?
I would, during that COVID event, the only stocks that I would remotely consider for purchase or for future purchase would be stocks that have the characteristics that Nvidia does at this time, because you can see that at the March period that Nvidia is actually showing relative strength to the S&P 500, staying in its primary uptrend, and the moving average continues to go in a northward direction, even with this very outsized reaction in the stock price itself. That decline there says that this is a stock that's acting better than the majority of stocks in the S&P 500. And that these are the stocks I want on my list for future action in when we determine the time is right to start to re-enter the market.
All right. Well, Bruce, I think this concludes it.
Wonderful job. Thank you so much, Roman. Now, we're not done yet with this case study. So we're going to button this up right now with a big thank you to Roman. And then we are going to do the next leg of this case study, which you'll be able to see subsequently in a future session of power charting. And Roman, with that, thank you so much for your time today.
Thank you, guys. It was fun.
Take care, everyone. See you next time.